Good morning, everybody. Micah Haints here, Senior Sales Associate at Noble Gold Investments, and your host today for yet another live stream. We've got quite a bit to unpack today. We're going to talk about Michael Burry, who is shorting AI stocks amid a tech stock bubble. Trump is also, as of the last couple days, floating a new 50-year mortgage proposal. And now we're also hearing about a $2,000 stimulus check going out to most Americans, except for high income earners. So it sounds to me like we've got more spending, more borrowing, and more easy money coming on the way. And you don't have to be an economist to know where that leads. Inflation doesn't care who's in office. And that's why we always say if you want stability, you've got to hold something real. Gold and silver don't need bailouts, they are the bailout. So, speaking of silver, just quickly on that other recent news, the Geological Survey of the US has just added silver as a strategic commodity and part of the list of critical minerals. This is a designation that's normally reserved for commodities that are in the national interest and provide economic stability. So, for a company like Noble Gold, one that's focused on helping people protect their wealth and physical assets like gold and silver. This is a huge piece of news for us. Silver is now shifting away from being just a store of value to also being a strategic commodity, as I've said for many, many years. So let's dig into what all this means for your portfolio, and we'll get right into it. So let's talk about Michael Burry. Of course, this is a legendary trader and investor of the Big Short fame, the one investor that accurately called the housing market collapse pre 2008. And of course, you've all seen the movie, I'm sure, where Christian Bale plays the infamous Michael Burry. Michael Burry now operates a massive hedge fund. It's his own company called Scion Asset Management. And just last week, they disclosed a very large bearish position where he has taken puts or he has shorted the two biggest names in tech, both NVIDIA and Palantir. Business Insiders report that the fund that he held or holds, he's put a $912 million bet on Palantir's share price crashing, and he has bet 187 million on the Nvidia shares crashing. So he's also issued quite a bit of public commentary as of late as to why he's doing this, and let's dig into that. Michael Burry appears to believe that valuations, or the way that tech stocks are valued, are overpriced and overheated. And he's now taking a major bet to suggest that they will actually correct to the downside. Now, he's criticized corporate assumptions in this sector for some time. Mainly, what he's saying is that they are not properly accounting for losses in the life cycle of the products that they sell. Just to put this into more kind of understandable terms, the earnings and the revenues that they share, which are part of why the stock continues to move so much higher, these valuations, he's saying, are actually hiding much much larger losses. When it comes to chips and the type of technology that these guys are saying, what you would normally do is you would account for their depreciation. We know that the world of chips is changing so quickly that the top tier chip this year is actually going to be worth less next year and the year after that. So the depreciation in those chips is not accurately being accounted for, according to Burry, and he suggests that earnings could actually be 20% higher than what they actually are if they were accounting for losses in this. Now, he has a pretty good track record, maybe not on timing, but he's very good at spotting these structural excesses. He was wrong for many years leading up to the 2008 crash. Pardon me. But he was eventually right. His thesis is correct. So I would say this is not necessarily the best timing indicator, but it definitely suggests that he's looking at the right things and that we could have a precipitous drop in these stocks once reality hits. Now, what does this mean for gold, silver, and the broader economy? Well, if Burry's correct, and if he's putting his money where his mouth is and he places the correct bet here, he's suggesting that AI stocks, which have actually led the stock market in terms of its growth for the last several years, they could actually be in a major bubble. Now, if these big names and others as well were to crash, they have also as well, and they have led the way up, but they would also lead the way down and drag the broader market with it. Now, if we have a tech bubble unwind, this would create volatility in the markets, major sell-offs across the board, and you could see the recession talks get a lot more serious. It could actually send us into a major recession. And so we'll have to see how this plays out over the next several weeks. But both NVIDIA and Palantir are among the leaders, and shorting them is a high conviction but high risk move from Burry, saying that he thinks that gravity and reality will catch up with these guys and help correct the broader markets at large. So, if someone who predicted the 2008 bubble is now betting against the poster childs of AI, we should take notice to this. This, again, not a great timing indicator, but it is definitely a warning sign. And there isn't just necessarily risk in the tech bubble, but it will impact the broader stock market and other paper assets. Now, if we do see a correction there, whether this or next year, it could lead to a flight of capital and a major rotation from risk on in stocks to risk off in precious metals. Gold and silver will be the primary beneficiaries of a stock market correction, whether it's isolated to the tech stocks and AI giants or not. One other quick note from this morning on this is that a large Japanese hedge fund or investment firm, SoftBank, has actually just sold $5.8 billion worth of shares with this news coming out. And that is just another little bit of fuel for the fire. So before we jump into section two and talk about the 50-year mortgage, let's cut to a quick commercial break. We'll see you when we get back.
When I first decided to invest in gold, I was a bit nervous and unsure how to start. Luckily, I found Noble Gold Investments. From the very first call, they made investing easy. No pushy sales tactics, no gimmicks, and no confusing free silver offers with hidden fees. Just honest advice tailored to my needs, giving me confidence every step of the way. If you're new to gold investing or want a partner you can trust, visit noblegoldinvestments.com.
Welcome back from that small break. And now we'll jump into the second piece of news we're covering in today's stream. Again, my name is Micah. I'm a senior sales associate here at Noble Gold. Throw out this too. We will be answering any questions from the audience as we go along. Feel free to throw in any questions or comments. I'll gladly address those throughout the course of the show. But now let's jump into the 50-year mortgage proposal from Trump that happened over the weekend. What is this? Why is it happening? What can we deduce from this? We'll get all into this, into these details right now. So the proposal that Trump is floating is the idea of enabling a 50-year fixed-term mortgage via government-backed entities like the federal, Fannie Mae and Freddie Mac. Now, this would make home ownership more affordable and maybe more accessible to more people. I heard an interesting stat this morning that the average age of first-time home buyers in the US has hit the highest age ever at 40 years old. That's partly been because of how expensive housing has become since the money printing that began after COVID. A lot of that money printing went into assets like housing, and housing prices have become the most unaffordable ever. And so this move to make longer mortgages going from 30-year fixed to 50-year fixed would allow for payments to be lower because you have a longer term in which you'd cover the payments of your home. Now, that might be cheaper in terms of carrying the cost of owning a home, but this would open the doors to a lot of other new buyers. And what we know is that this would potentially be stimulative to housing prices. So if we have an unaffordability or a housing crisis with respect to how expensive homes have become, this might actually open the door to a bunch of new buyers and push housing prices up. But of course, it would be cheaper every year over a 50-year mortgage to afford your home rather than a 30-year. But let's do the math. If 40-year-olds are first-time home buyers on average now in 2025, they'll be 90 before their homes are ever paid off. Sounds to me like you're more or less renting your home for the life for the rest of your life for pretty much the length of that 50-year mortgage. Now, we've got some critics, some in favor, but this says to me a couple of things. I believe this is because they're afraid of a housing market correction in some part. This would help, like I said, maybe boost home prices and avoid a correction, but it may also take a bunch of housing inventory that's been stockpiling off of the market as well. So more buyers means more competition, and that would have upward pressure on home prices. In other words, easier credit means higher asset valuations. And so if this easy credit coincides with limited supply, you could have a recipe for disaster with respect to house prices. Now, extending terms of the debt keeps money longer or keeps money in the system longer. And that means that these payments are going to be stretched much further. So, this 50-year mortgage would mean that there's so much more debt locked up in the system, and longer term debt also means less equity buildup earlier on in these homes, which tends to amplify making it more making housing more leveraged, and that tends to amplify housing prices. So from a macro perspective, more credit creation, more debt potentially with weaker discipline on underwriting. I know that they're dropping Freddie Mac is dropping their credit score requirements for this and are deciding to do their own independent analysis. That tends to be in favor of inflation, asset inflation. Pardon me. So if housing becomes more affordable monthly, but some households spend free cash on other goods or investments, that might free up money for elsewhere in the economy, like consumer spending or investing in other asset classes. Also, if the policy stimulates housing demand when supply is constrained, you might see inflation in housing related sectors like construction, labor, materials, and that'll spill over into the broader economy as well, meaning that inflation is here to stay. Now, what is inflation? It's a weakening currency. Asset inflation and credit expansion tend to erode purchasing power of cash and savings. When you know that your money buys less in the future, tangible real assets become much more attractive. And if the dollar weakens, then gold and precious metals are seen as a refuge, a great place to store your wealth outside of the dollar. We know that this year alone, the dollar dropped 14% relative to other currencies. And obviously, gold and silver have had a tremendous year, but this is a reflection of destruction of the buying power of the dollar. Now, when it comes to this proposal for 50-year mortgages, we've got to ask, what does this mean? So if the government's pushing policies to expand credit, lower monthly costs, and incentivize real estate purchases, we're heading into a more leveraged and asset inflated environment. And that's a red flag for anyone who's relying purely on paper cash or paper assets. Now, in a world where housing is easier to finance but still short on supply, this will definitely push housing prices up and cause an even worse housing affordability crisis. So, yes, this 50-year mortgage plan makes monthly payments easier, but it also locks people into very long terms for debt. And we could see a lot of risks around that with respect to the purchasing power of the dollar trending lower over the next years and decades to come. So let's take a quick break before we jump into our last section. We'll also do a few questions when we return right after this.
We're talking to people today about investments. Let's see if we can get somebody. Excuse me, sir. Do you have a retirement account?
I do. I'm invested in some annuities.
Fixed income? How is that?
It was better a few years ago. Each year, it buys less and less, barely keeping up.
That's where gold can make a difference. Unlike fixed payouts, gold rises with inflation, so you're not stuck with a low fixed payment.
So gold isn't stuck in the past like my annuity?
Don't let inflation erode your retirement savings. Invest in gold. Invest with Noble Gold Investment.
Welcome back, and we'll cover our third section for today's stream, talking about Trump's $2,000 stimulus check. Now, Trump's floated the idea of giving most Americans, excluding those who make too much money, a $2,000 payment or a dividend funded by revenues received from the tariff policy that had been implemented since last year when he became president. Now, revenues collected from this tariff program are going to be distributed to Americans rather than kept and used on paying down the debt or other programs. Now, this plan has not been fully implemented. It's just being fleshed out in terms of the ideas around qualification and distribution, but this is why we should care. This would potentially boost consumer spending. $2,000 to every American puts more money in their hands. It increases consumption, and we could see the prices of everyday goods rise. It also has implications for asset inflation. And when people have more cash, we know that that money flows into things like stocks, assets, housing, and those types of things. So this small amount might not push up the housing or stock market, but definitely the consumer goods. Think about food, groceries, other items that might be consumed at that kind of level. Now, if the checks are paid out without matching sufficient revenue, then there could be an increased debt burden on the country. One of the things I heard in a video from Trump this morning was that we still have the tariff issue before the Supreme Court. Now, if tariffs are deemed illegal or non-constitutional and the tariff program is shut down, then that would potentially undo this dividend program as well, but also create a massive hole in the government's financing model. And so this stimulus could be a good thing for lower income Americans in the short term, but have very big implications for consumers and consumer goods inflation and asset inflation. Now, a few key risks and caveats just to hit on. There's feasibility concerns. Economists estimate that 2,000 per person could cost like 300 billion or more. And tariff revenue to date is much smaller than that, amounting to only 90 billion. So the math doesn't support this number to be issued yet. There are also some legislative and legal concerns and hurdles. The tariffs funding this are again under judicial review, and we can't have any of this stuff happen until that's been sorted out. Now, inflation risk, that's obvious. We've mentioned that before. Injecting stimulus when inflation is already on the way back up could hurt us in the long term, although feeling good in the short term. And then timing and distribution, we don't know when this would happen. It's unclear as to when or how it'll be rolled out, and we'll keep an ear to the ground for our followers on this, and as it relates to gold and silver as well. And so I'd like to take a quick question from the audience here. I've got someone asking, is silver going to $75 next year? Let's just talk about what we've done first in 2025. So silver started the year around $28 an ounce. It went all the way up to 34, where it churned for a while and then dropped back to 28 after Liberation Day. And we had $27, $28 silver in the middle of April. Now, since April, we've seen a jump from $27 all the way up to 54, effectively silver doubling in just a few months. But from the October high just a couple weeks ago, we dropped from 54 all the way back down to 48. Now, silver is up above 50 again. Is it back on the move, and will it take off to new highs, or does it have further time to consolidate around here? I'd say it's a 50-50. There are some suggestions that we could still have a bit more consolidation, maybe a smaller correction that needs to happen between now and the end of the year. But yes, to this question, I do believe we'll make new nominal highs in 2026. When it starts, that's sort of what's up for debate. Now, whether it's we shoot right up to new highs through the end of the year, or we have to spend a few more weeks or months going sideways. To me, I only look at the metals as a long-term play regardless. This is a great time to get in. It's still cheaper than just a few weeks ago. And I would say, having gotten to 54, we could see another 50% move in silver once it breaks up above there. So 75 is clearly within range. Some analysts are saying that we could see another measured move, a lot like the one that we just had, so 100% or more. So we'll have to see what we've got in store, but the underlying thing that I want to emphasize is that, silver today at $50, still lower than it was a few weeks ago. Could it drop another couple bucks? Sure. But either way, the long-term perspective is this is going much, much, much higher in the years to come. 2026, I think, will be a year of new highs for gold and silver both. And I think that's it for questions. So what I'd like to do is thank the audience for being with us, joining yet another live stream. If you'd like to chat with me, again, I am a senior sales associate. You can call and ask for Micah, but I'm one of about 10. There are 10 great salespeople here. All of us are investors. All of us live and breathe this stuff. We're here to help you make the first moves to understanding how you can get into physical metals, whether with a retirement account or for a home delivery purchase at home. And I'll throw up our number here. Call me or any of my sales associates. That's 877-646-5347. And it's Micah from Noble Gold with another live stream. And we'll see you all soon. Thanks for